According to Richard Dennis, X is the key to successful trading, not intelligence. What does X refers to? Let's see if you can spot it out in the video. If you do, please answer it in the comments. Richard Dennis started his trading journey with just a small loan from his family, borrowing $1,600 to fund his dreams. With this, he took the brave step of purchasing a seat on the Mid-America Exchange for $1,200, which left him with only $400 to trade with. But with a mind focused on success, he turned that $400 into an incredible $200 million. It's a true rags to riches story that proves that with hard work and the right strategies, anyone can achieve success in trading. Today, Richard Dennis is one of the most well-known traders in the history of financial markets. He is renowned for his successful trading career and his ability to turn a small amount of capital of $400 into $200 million. He achieved this by following a set of trading rules that he developed and refined over many years. In this video, we will explore Richard Dennis' trading rules in detail and explain how you can use these rules to boost your trading performance. Let's begin. Rule number 1, the survival rule. First and foremost, he preaches to always use a stop loss. He explains that the only thing I teach traders is to always use a stop. That's the only rule I have. I call it the survival rule. Because if you don't use stops, you'll eventually go bust. A stop loss is an order that is placed to sell a security when it reaches a certain price level. By using a stop loss, traders can limit their losses in case the market moves against them. He advises, never risk more than 2% of your account equity on any one trade. He explains that you can't control the markets, but you can control your risk. Proper risk management is the first pillar of any successful trader's rulebook. They have plain and simple rules in place to make them stay in business even after encountering losing streaks and drawdowns. They have learned it the hard way that you cannot be right every time in the market, and playing good defense is the only way to succeed in this business. On averaging down, he says, never add to a losing position. Whenever you find yourself in a losing trade, your job is to get out of it as quickly as you can. Never, ever average down. Rule number 2, trend is where the money is. Dennis' second rule is to trade with the trend. He believes that the trend is your friend, and that by following the trend, traders can achieve significant profits. He advises traders to use technical indicators such as moving averages and momentum to identify trends and to stay with those trends until they reverse. Richard Dennis is an avid trend follower. Most of his trading strategies are designed to capture a trend. As he explains in his interview in the book Market Wizards, I am a trend follower. I try to identify the trend of the market, and I stay with that trend until it reverses. He believed that markets move in trends, and that by following these trends, traders could achieve significant profits. Rule number 3, cut losses short and let your profits run. This is a rule that is unquestionably common among all the successful traders. He said, I know this will sound like a cliché, but the single most important reason that people lose money in the financial markets is that they don't cut their losses short. He advises traders to take your losses quickly and move on. Don't hang on to a losing trade hoping that it will turn around. In addition to cutting losses short, Dennis also believed in letting profits run. He said, if you don't stay with your winners, you are not going to be able to make up for the losers. He believed that by following the trend, traders could capture large profits in a trade and should not exit too soon. He explains that if you have a good trade, let it run. Don't take profits too quickly. By allowing profits to run, traders can achieve significant gains on their trades. Rule number 4, swallow your ego. Dennis stressed the importance of discipline in trading, saying, the best traders have no ego. You have to swallow your pride and get out of the losses. He believed that emotions such as ego and fear could cloud judgment and lead to bad trading decisions. Market is always right, don't argue with him, don't fight the market. To sum up, learn to observe what's happening in the market without any bias. Rule number 5, use price action. Never trade when there are no clear opportunities. He advises traders to wait for the right opportunity to present itself before entering a trade. By waiting for clear opportunities, traders can avoid entering trades that have a low probability of success. Dennis used price action to determine entries and exits. He used technical analysis tools like moving averages, momentum, and other indicators to identify trends, but ultimately it was the price action that guided his trades. Using price action to determine entries and exits is a common strategy among successful traders. It involves analyzing the movement of the price of a security over time, looking for patterns that indicate a potential trend reversal or continuation. The advantage of using price action is that it can provide a more accurate picture of market sentiment and investor behavior than other methods. Technical indicators can be lagging or misleading, but the price action is the result of the collective decisions of all market participants. By reading the price action, a trader can gain insight into the psychology of the market and potentially make better decisions about when to buy or sell. However, using price action requires patience, discipline, and a willingness to let go of preconceived notions about the market. It's easy to get caught up in the hype or fear of the moment and make emotional trades based on news or rumors. But as Richard Dennis said in Market Wizards, the key to trading success is emotional discipline, not intelligence. If intelligence were the key, there would be a lot more people making money trading. By relying on price action and sticking to a disciplined trading plan, traders can increase their chances of success in the market. In conclusion, Richard Dennis trading rules are based on trend-following strategies and are designed to help traders achieve significant profits while protecting their capital. By using a stop-loss, limiting risk, trading with the trend, letting profits run, cutting losses short, avoiding adding to losing positions, and waiting for clear opportunities, traders can improve their chances of success in the markets. These rules have stood the test of time and continue to be relevant to traders today. Remember, trading is not a get-rich-quick scheme, but a long-term game that requires patience, discipline, and a willingness to learn and adapt. He started a program in 1984 to test if trading could be taught to beginners by making them follow a set of rules. The results of the program surprised the entire world, and all turtle traders became millionaires.